So today we have Chris Smith from Playfair Capital. Thank you so much for being here.
Thank you for having me.
Could you give us an overarching view of what you do, in a professional sense, obviously, and just give us an understanding of Playfair Capital as a whole?
Of course. So maybe I'll start with a little bit of history. So
Okay, yeah.
Playfair was founded in 2013 by a guy called Fede. He actually started out as an angel investor. So he came to London in 2010. His main driver in life really was he wanted to have an impact in the world.
Yeah.
And he'd previously worked with some NGOs and some charities, found that a little bit dissatisfying. It wasn't really having the impact he wanted.
Yeah.
So he started angel investing and actually worked with Robert and Eileen, who are now Passion Capital. So worked out of White Bear Yard.
Yeah.
Planned to do about 6 angel investments and ended up doing about 25.
Wow.
So obviously found his passion.
Yeah.
But realised that actually to support those founders to grow their companies and also just to manage the paperwork, he really needed a team around him. So he incorporated Playfair in 2013 and hired a team.
Yeah.
And then we kind of split it into 2 funds. So the first fund was from 2013 to the end of 2018, deployed about £20 million into about 50 companies across 11 countries.
Yeah.
So if you look at our portfolio, it's really broad. And we've got a car company in Kenya, we've got B2B, we've got B2C, all because the team was really investing with kind of an angel mentality. And then Fede stepped back from the fund, but wanted to keep Playfair growing. So I joined in November 2018. He gave us a £25 million commitment to do a second fund. So that's what we've been deploying since March last year.
Yeah.
And the focus of that fund is a little bit more on deep tech, so kind of AI, machine learning and computer vision. And we have a preference for B2B, although we will still look at consumer deals. So we think there's a real advantage to being a generalist fund.
That's interesting. And you said, how did you find your way into venture specifically?
Oh, okay. So a winding path.
Yeah.
So I started out. I'm going to take it all the way back to school actually, because I think it shows you a lot about the kind of career advice that was around when I was there. They basically said to me, Chris, academically you're doing reasonably well, so you can be an accountant, you can be a lawyer, or you can be a doctor.
Exciting.
And I went, well, I'm okay at numbers, I'm competent, but I don't love them. I don't like blood, so lawyer.
Yeah.
So I kind of signed up and got on this crazy treadmill, which ended up lasting about 10 years. So I worked for a big US law firm doing private equity and M&A. I spent a bit of time in Silicon Valley and then moved to a family office in the Isle of Man, changing from being a lawyer to an investment manager. And then on the Isle of Man, the investment manager job actually wasn't an investment manager job, it became an operational job. And ended up being sales director for 2 years and head of the software development and data science team for 3 years at a B2B business called Plan.com. So I ended up having this amazing kind of scale-up operational experience. So the company went from 6 people to 100 people and nothing to 50 million in revenue in 4.5 years.
Yeah. And
then I met the team at Playfair. So I actually wasn't thinking about moving, but through one of my angel investments, I was introduced to Joe Thornton there, got talking, and after 3 months it felt like a perfect fit. And I'd also on the side, so I was also a founder, so I had my own telecoms business at university, which started being cheap international course for students, but we scaled up to be for the kind of the broader public and ended operating from 14 countries. Amazing. Which was quite good fun. It was only really ever a hobby business, but I learned a lot building it. And I've also been an angel investor for 10 years. Had done 14 deals and had sort of 3 exits along the way. So I would never say I joined the dots and planned getting into VC, but all these things kind of came together and it just felt like the right place to be.
That's really interesting. And so you guys are an angel fund. What do you think about, what do you focus more on as opposed to a Series A investor? So, what attributes, skill sets do you guys need to pay more attention to when it comes to, investing in seed deals?
Yeah, I think, so when founders come to us, and because we invest a lot in deep tech and technical founders, they're often quite raw. They've got an idea, maybe they've got a little bit of traction, but they do need a lot of help. So what we look for, honestly, is raw talent. It is founders who have ideally kind of deep domain expertise in whatever they're doing, but probably even more importantly, the character traits that suggest they're going to go on and build a big company. Because building a big company is really hard. Things like persistence and grit and determination, all these things, it's quite hard to quantify, but you just get a gut feeling when you meet someone. That's really probably 80-90% of what we're looking for. And then the other thing, obviously, is a market that's big enough to build a big company. Because for us, our economics, the power law of VC means that we are going to make 25 deals out of this fund. We know some of them won't go on and be successful. So the ones that do need to have really big outcomes. So we're looking for the billion dollar potential. And to your second point, what do we kind of help on? I think these founders typically are a little bit weaker on sales. So I mentioned I ran the sales team, so we help them a lot. Sales strategy, building out the sales team, getting like commission structures right. We help them on PR, we help them on marketing. My colleague Joe in particular helps them on hiring. So probably, I think the biggest challenge going from your seed round to Series A is you're probably going to have to add at a minimum 5 to 6 people to your team, maybe more. And if you hire well, your company is hopefully going to do well. If you hire badly and make mistakes, it's going to put you in a really difficult position. So Joe gets very hands-on with the team, giving them just all his experience working at Google and Facebook, hiring, and helps them with that. So I say that's the key thing. And then we help them more generally, with just strategic thinking, being just a sounding board that they can bounce ideas off. And then Henrik is very strong on financials, so helps them build out the financial model and get that correct or get it right for Series A.
Yeah. How do you think about, say, market, technical, and founder risk? Is there a specific type of risk that you just refuse to take, and what risk do you actually lean into being a seed investor?
So obviously, when we see companies, the key thing they don't have is product market fit. We don't have sufficient proof to know that there is a demand for the product in the market. So that's clearly the risk that we're taking. I think we are happy to take risks on big ideas. Some of our investments are the future of autonomous flights and urban air mobility. We've got investments in maritime autonomy. There's some really big plays that we've made, but I think we minimise that risk by backing what we think are exceptional founders. So that's really what it comes down to. We will back exceptional people, and that is the only real way at seed stage you can de-risk investments.
Yeah, in terms of de-risking investments, how do you think about specific markets? You said that you look to approach large markets, but how do you look? What's your thinking process around investing in regulated markets?
I think we do avoid some things altogether. So in the HealthTech space, we generally avoid medical devices, diagnostics, and therapeutics. So things that typically need to go through clinical trials and clinical approvals, simply because with the size of our fund and the amount we invest, most of that money is going to get chewed up by the approvals. They're then going to have to go on and raise subsequent rounds, which is very dilutive to us. And it's an area we don't understand. So we only invest where we really understand what we're doing. Where we are more happy to take a view with the regulator, again, is if the company has proven at least some early engagement, has proven that the regulator is open-minded. So instead of HealthTech, we kind of de-risk by really focusing on companies that are using kind of AI, machine learning, big data approaches, or digitizing workflows, or doing things that aren't directly related or don't need clinical trials, or have ways of getting to market that doesn't at least initially involve a clinical trial. In other areas, so for example in autonomous flights, our investment there, we know the regulator is very open-minded and very supportive of what the company is doing. We took a reference call with them, and we're happy to sort of take that risk. We think we can work with them.
Yeah. How have you seen the health tech sector evolve, and how was it in 2008 when you first start investing?
It's a good question. I don't actually remember seeing any health tech deals when I was first angel investing. Yeah,
because the technology in the NHS were all old legacy systems, and they were tied into long-term contracts.
I think that's right. So I think, first of all, the UK specifically, you've got the NHS, which is this, amazing, beautiful system on the one hand, but if you're an entrepreneur trying to sell into it, very difficult. It's like this crazy village. But I also think there are trends in investment, right? So when I was first angel investing, people, I mean, SaaS was kind of emerging. People weren't even really talking about AI. But you've had trends like AI, like blockchain. You've had these things that come through. HealthTech is definitely very hot at the moment, and I think it's actually because entrepreneurs want to get involved with it. I think it's kind of as simple as that. I think also entrepreneurs are taking a bit more of a global approach. So one of the key things for the whole ecosystem in London and the UK is that if you want to build big companies, you've got to have this huge vision, this ambition. And now a lot of the founders we meet are saying, well, look, I'm going to build something here, get a few proof points in the NHS, and then actually next stop is the US, next stop is Singapore or whatever it is. So yeah, I think there's been a lot of positive change. Of course, other general changes have happened, so it's a little bit cheaper to launch a company now. Building apps is a bit more commoditized. So actually, it's a lot easier to take your idea from a piece of paper to something you can start testing. Plus, you've got the growth of the accelerators, you've got Entrepreneur First, you've got an ecosystem that's really grown up to support those founders.
With the most recent innovative initiatives, you've got the NHSX, you've got new data flows, you've got the onset of the smartphone. That's played a massive part in developing the health tech scene right now. How have you seen the business models actually evolve in the health tech sector?
I think I'm going to be part optimistic and part pessimistic here. So look, I think things like the NHSX initiative is good. I think there is more grant money available. There's money for companies focused on AI and health tech, more grants, etc. So there is more support. However, the vested interest, the bureaucracy, and the sort of slow-moving nature of the NHS remains. So I think yes, you can get more support at the outset, but let's not underestimate the challenges of selling into the NHS as this kind of big organisation. I think the founders that are doing best are figuring out that there are multiple ways of selling a health tech product. So you can go B2C, right? You can go directly to your end user. You can distribute B2B2C, potentially through charity partners. You don't have to go to hospitals. You can go to GPs. You can go to primary care. You don't necessarily have to start in the UK. You can go to the US. And also you can partner with pharma as well. Potentially that's an option. So I think the key thing with healthcare, it's like other sectors. Sales cycles are long. It's quite difficult to sell in, particularly to the NHS. Founders are more aware of that and building business plans that allow them to get traction in other places first.
I mean, in terms of, are you okay for us to touch on a couple of your portfolio companies?
Yeah, of course.
So, I mean, you made an investment in UMed. So you're really active in the health tech scene right now. What drove your investment decision into Vine Health specifically? Because we interviewed them previously. So I read the article. It mentioned longitudinal patient data. Would you be able to kind of highlight some of the nuances that really drove your decision to invest in a company like Vine Health?
Absolutely. So let's step back. Actually, we're a generalist investor, right? We didn't set out to invest in health tech. But it's actually sequential. So we actually met UMed. We met Matt at UMed first. And Matt came to us with this proposition that it's really hard for pharma companies and researchers, in fact anybody, to engage patients for whatever you want to do, whether it's clinical trials, label expansion, testing new products, whatever it is. And he built this platform that basically enables pharma and researchers to do that. It's quite complicated how it's done, but it's basically done through a network of partnerships and quite a complicated tech platform. But we got really excited with what he was saying, where a lot of VCs didn't perhaps quite understand it. And I think that's partly because I have a legal background. He was talking a lot about GDPR and showing us white papers. And if you fast forward, only about a year, UMed now has 1.1 million patients on its platform. Which, if you compare it to someone like Patients Like Me, which has 600,000, Patients Like Me raised $100 million and we've raised 850,000. So that really gave us this kind of insight to the importance of being able to engage with patients and also being able to collect data in a compliant way. And then we met Raina and Georgina at EF. So Raina presented. And we just realised that if you're a cancer patient, you go and see your oncologist once every 3 or 4 weeks. The only time data is being collected about you, so your blood test results and other things, but also your symptoms, is once every month. So we're missing a huge opportunity to really understand what's going on with the patient in that period. And that's what we mean by longitudinal data. We mean something that, you know, is continuous and frequent. So Vine Health is saying, actually, we can collect data from the patients, both from their devices, so things like how many steps they've walked or their sleep patterns or whatever it is, but also data that they input themselves as to how they're feeling and to make sure they take their medication. And when you then start seeing those patterns, it enables the oncologist to give better care, enables the patients to understand what they should do to improve their well-being. So just, you know, as an example, if we figure out that a patient walks 1,000 extra steps a day and their symptoms are reducing, then the recommendation is on one day when they've only done 2,000 steps, okay, you need to walk a little bit more. So the whole combination of collecting this longitudinal data and then some behavioural science to nudge them to take these actions was really quite compelling. So we got really excited by Vine Health because we think it can make a massive impact to cancer patients. And obviously a lot of Playfair, we want to invest in businesses that have this really big impact. But actually, again, on the longitudinal data side, there is a great model there to work with CRO and pharma companies in the future to enable them to develop better drugs and do better things for patients.
It's amazing. Like what we're seeing right now is like kind of a shift from like a top-down healthcare system to a system that really puts the patient at the center of the care. And like with the onset of the smartphone data flows, like it's really like we're kind of seeing, I don't know, we're not seeing the NHS dismantle, but we're beginning to see the patients really being taken care of, and a lot of these clinicians and radiologists being able to augment their abilities to really take care of the patients, and it's amazing. In terms of different industry, I mean, your perspective on media, you invested in Cairo, which was quite it was a unique investment. I mean, I found it quite fascinating the way they create content. I mean, could you give us a bit of an understanding of why you invested in Cairo, and also tell us the story about you watching that documentary on Nikon? It was pretty fascinating.
So Cairo, I mean, actually the story goes back quite a long way. So the founders, they started coming to Warner Yard years ago and actually charmed the receptionist to give them free desk space. So they were working in our office for, I think, at least 6 months, not paying any rent, hustling, building their company. And actually they originally were building a dojo. They were building an app. And our founder Fede kind of bumped into them in the atrium and was like, "What are you guys building? It looks really cool." And that's how the investment happened. So these guys from the beginning, born hustlers, work incredibly hard, very smart, and started out with that project. They quickly kind of realized that the future was in trying to address Generation Z or Z's kind of appetite for media content. And their real insight was that generation wants to actually watch long-form content. So the thought before was that everything should be kind of short, 90-second clips, everyone's got ADHD, whatever. But actually they realized if you can write really good content with really compelling talent, then people will watch it. So they started producing their first shows, PAQ and Niva. And it was really around this whole theory that generation does not sit in front of the TV and watch BBC One all evening. It just doesn't happen anymore. You know, it's the on-demand generation. So I think you look at it, you've got the older generation that watch regular broadcast TV. You've probably got maybe kind of our generation that watches a lot more on demand. But if you look at the 16 to 24-year-olds, they're not even in the same place. They're on YouTube. They're watching influencers and vloggers, you know, creating their own content. So Cairo really piggybacked on the top of that and produced, you know, really high production value shows. And as we were saying, you know, their monetization model is they have sponsors for their shows. And it's very sort of upfront and open. Their shows are sponsored. But it's the power that's so interesting. So, you know, I watch quite a few of their shows. I'm clearly not the target audience, but I still enjoy them. And I was watching this one with a Nikon camera, and the guys in PAQ are going to New York. And I thought, I know that there's some kind of advertising going on here, so I'm going to resist it. But 8 minutes later, I was on Amazon, Googling this camera, looking at the reviews, thinking, oh, maybe my wife wants a new camera. So clearly the power of watching people in a really interesting story, using a product is a very effective form of advertising. They've also been very clever at how they source talent. So actually, the guys in PAQ and the women in Niva, effectively, Kyra created that talent. So they interviewed a bunch of people, hired them, and then turned them into media stars. And then they've recently signed a guy from TikTok, who was one of the biggest stars there, and brought him over to the Kyra platform as well. So they're expanding the range of shows they do as well.
That's incredible. That's incredible. I mean, in terms of, you're on the board of Vine, Orca, UMed, Kyra. What have you learned, and how have you evolved as a board member, since being on all of these boards?
So I think you learn a lot of, there's a lot of things that happen in companies that you can pass on to the other companies. So a lot of I guess I call it cross-pollination. So particularly between companies in a similar sector. So I think UMed and Vine Health are a great example. We're able to share introductions to pharma companies, insights on grant opportunities, sales strategies. So for me, being a board member, it's just been about learning best practice in the industry, and then leveraging and taking advantage of all those connections we're making. And I think as a proactive board member, the main thing is to figure out, where your founders, might be struggling or not quite, or maybe they've taken the eye off the ball slightly. So they have this kind of completely zoomed in every day, 18 hours a day in the company. We're able to step back and just say, actually, I think you're perhaps not quite as focused as you should be on the next round of funding, or not quite as focused as you should be on selling into this particular category of people. And also, I think increasingly I try and help and figure out where stuff is not working.
Interesting.
Because when you have, the whole VC model, when you've got 18 months of runway, actually, if you're banging your head against the door, you should be putting your resource somewhere else. So we try and help with those strategic decisions. So if you're selling into these stakeholders over here, it's really not happening. Okay, let's rethink the strategy. Let's try and sell into a different category of people, use a different method.
You get a lot of VCs saying they're founder friendly. I mean, in your opinion, and kind of taking it from an entrepreneurial standpoint, are there heuristics or certain signals founders should really look out for when choosing to go on with a VC? I guess the first criteria is, are they going to give me money? But in terms of assessing whether or not they're founder friendly, do you have any insight on what a founder can actually look for? For
sure, this is a big thing for us at Playfair. So I think as a founder, clearly you need to raise money to keep your, to fulfill your business ambitions. So there's quite a lot of pressure that comes on you to take money from any way you can get it. But I do think founders should see it as very much a two-way relationship. It is a 7 to 10 year journey. You are going to be working very closely with these people. So I actually think it's the same as hiring someone. It's the same as dating someone and getting into a relationship. Does it feel right? Trust your instinct. And what we find with deals that are sort of progressing in the right way, and we really like the founders, it's very natural. So we'll have a first pitch, we'll be excited, we'll ask them to send some information, the second meeting happens, it kind of naturally accelerates, suddenly we're on WhatsApp with them, there's a WhatsApp group, we're chatting about things, and actually we tend to help work with companies and support them way before we've closed an investment. So I think founders should say, naturally, does this feel right to me? Obviously, the other things to do, just due diligence. So, have a look. Does the fund write a blog? Do they have any press coverage? What's the type of stuff they're writing about, and how do they think about things? Definitely take references from other founders. So we really encourage our founders. Anyone in our portfolio you want to talk to, go and chat to them. Find out about their experience with Playfair. Try and identify companies actually. For the fund that probably aren't the stars, and see how that's been handled as well. So definitely do your research there, and ask questions. What are you going to do for me? How are you going to help? So, and again, get examples. So we help on a lot of stuff. We help on sales, I mentioned before. We help on hiring. We help on the finances. We help on networking. There's an awful lot of stuff we do, but don't kind of take our word for it. Check and see what other founders think. I mean, throughout the courting phase, what mistakes have you seen entrepreneurs make throughout that courting phase with you and
other investors?
I think the biggest mistake is probably the early one with sort of the initial engagement, and I think pitch meetings should be a two-way dialogue. So we should be getting into a Q&A session, because if we're asking questions, it means we're engaged. If you're just talking, then it means that we may be slightly switching off. It's just kind of unavoidable. If you talk for 45 minutes, people don't listen. So the biggest mistake founders make is they're so excited to talk about their business. Obviously, it's a big opportunity to be pitching an investor, and they just go woof for 45 minutes. And you get to the end and you go, wow, okay, you've just talked to me for 45 minutes. I didn't get to ask any of the questions I wanted. So I think you have to, again, see it like a little bit like dating. So the first date, you want to tell the investor a little bit about what your company is doing, enough to excite them, enough to want to find out more. And leave room for questions and encourage questions and try and get into that dialogue. So I think that's probably the biggest thing. I think the other thing to sort of mention is that, when we pass on deals, we try and be helpful. So we do try and give some indication of what it is that we're not sure about. We don't have conviction in the size of the market, or the valuation's too high, or whatever it is. So I think founders should be really actually a little bit insistent on getting feedback from their investors on what it is that they don't like. And one of the best questions to ask actually is not just what didn't you like, but what would it take for you to reconsider making an investment? What do I need to prove for you to re-engage with me? Because that then makes the investor really think about why they didn't like your company.
That's interesting. And in terms of your perspective on, say, price sensitivity, I mean, you've been in the VC world since 2008. How has that changed, and what do you think have been the contributing factors? Obviously, valuations are going up. We're seeing the rise of pre-seeds and pre-seeds. We've got accelerators coming up. Antler more recently. EF. I mean, what's your perspective on price sensitivity, and how do you work around that?
So, I mean, valuing a startup is a difficult business anyway. So we're generally pragmatic about it, and I think we sort of ask founders to do the same. So if they come in and they're just raising too much at too high a valuation, we'll tell them, we'll just say, look, we don't think that's quite the right thing you need to be doing. So I actually think what you said about this sort of being a trend with valuations increasing, I think is broadly right. But we've definitely seen actually founders being more realistic in terms of what they need to do to get their round away. So, I mean, my advice again here to founders is don't give us a valuation, because a lot of people have in their deck we're raising at 5 million pre, or 7 million pre, or 2 million pre. You should never put it in your deck, because you're going to put yourself in a position that's probably not advantageous. You've either gone too low, so you could have raised a higher valuation. You've gone too high, so a lot of VCs are just going to say, no, forget it, I'm not interested. Chances of you getting it right are pretty slim. So it is a market. You just want to say, look, the real yardstick is 20 to 30% dilution in a seed round is what the founder should be expecting to take. And that's kind of the sort of the boundaries that we work within.
You mentioned that you wanted to talk about, you've got the founder-friendly, you had a health program?
So one of the things so one of the things we did in December was, obviously we work really hard to support our founders, and I guess, our structure is we have a single LP, so our founder and chairman, which I think probably frees up about 30 to 40% of our time that would be spent raising from LPs. That gets spent with our founders. So we like supporting our founders, we love working with them. One thing we kind of identified was, as a founder, it's a real emotional roller coaster. It's really hard, and often they don't have the time or access to take care of their mental and physical health. So we put together the Playfair Wellness program. Pretty simple. They get £50 a month, and they can take advantage of about 3,000 different wellbeing activities at a time and place to suit them. So it's your usual yoga, Pilates, gym passes, but it also includes things like boxing and ice climbing, diving training, even massages. And for us, it's a small thing, but it's just, we really believe that the founders need to take that time out and look after their health.
How do you think mental health needs to be approached when it comes to entrepreneurship? And do you see entrepreneurs making a mistake when it comes to, running their company and just running themselves into the ground? Do you have any perspectives on this?
I think it's a very difficult issue. So we'll start there. I think running a business is probably is certainly one of the hardest things that anyone can undertake. So for me, there is actually the starting point of motivation is so key here. So if you are starting a company because you're passionate, we talk about missionaries and mercenaries. If you have a mission that you have to build this business, I feel like long term those founders tend to do better because that mission keeps them going. If you're in it to make money, then there are a lot easier ways to make money than start up a company. So I think starting it with an understanding of what motivates you is really, really key. On the kind of mental health generally, I mean, obviously you have to work incredibly hard and long hours and everything, but we try and encourage our founders to at least just step out of the madness from time to time. And that, again, the whole thinking behind the Playfair Wellness program was, even if a founder steps out for 1 hour a week and does something away from their desk, it's going to just allow them to clear their thoughts and clear their mind a little bit. So, we're realistic, it's very tough, but that's kind of a small way to help. The other thing is, when you're going into this, having the support of your family or whoever, you're the important people in your life is really key as well. So we actually ask, which is maybe a strange question, but when we get to know our founders, we're kind of interested to know about their personal life, not because we're nosy, but because you think, well, if you've got kids, let's say, and you're about to set up a company, who's gonna look after them? How's that going to work? Is it going to create a strain? What does your husband or wife do, or your partner? So we like to understand those dynamics and try and support there as well. But it is an incredibly tough thing to do. And I don't think there's any easy answers apart from just trying to step away a little bit. And the recognition that it's a marathon. So I think the media portrays success as a startup founder as something you can achieve in a couple of years and suddenly you made a fortune, you're off on the beach or whatever you want to do. Totally unrealistic. To actually build a big company takes 10, maybe even 15 years. So if you're going, absolutely flat out, you're not going to last the course. So I think finding, what an appropriate level of hours and work is really important, and just see it much more as a marathon.
And kind of find your own formula and see what.
Exactly.
Yeah. Is there anything else you would like to cover? Otherwise, we can go to the quick fire round.
I don't think so. No, it's great.
Yeah. Awesome. Most valuable purchase under 50 quid.
Wireless headphones that I actually bought for £6 from Talbo, which is the Alibaba kind of B2C company. So I can listen to podcasts and music and other stuff on the way to and from work.
What are your favourite podcasts?
So I like, there's the HS Health podcast.
Great podcast.
Really absolutely love that. Obviously, I can't not mention Harry Stebbings. The guy's obviously a bit of an industry legend, so I love listening to that as well. And then my colleague Joe has introduced me to Joe Rogan's podcast as well, which is a little bit more, not investment specific, it's just a bit more focused on kind of life. So I think those are probably the three.
Amazing. Is there a book that you would gift to a fellow startup founder? Or have you to any of your portfolio companies?
So I think my favourite book, and I'm actually 2/3 of the way through it now, is about Bill Campbell, who was this legendary coach in Silicon Valley. He worked with all these massive companies, from Google to Apple and everything else. And it's basically about his approach to coaching, which I think is valuable hugely for me, my role as a board member and investor, but also for the portfolio. So my favourite book, and certainly one I will pass on to founders as well.
Amazing. And is there a failure with entrepreneurs specifically? Are there specific failures that you've seen quite often at the beginning that generally, in hindsight, set them up for success later on during their journey?
So I think if you look at all the stats, I think there was a Harvard Business Review article came out recently. The average successful founder is 45 years old, which is not to say we invest in loads of first-time founders, but I think. And I'm not sure I'm quite answering your question, but I think people are in a rush. People are in a rush to found a company when they're like 22 and make it a huge success by the time they're 26. That's not necessarily realistic. So I think the way that I've looked at kind of my career is just do stuff you enjoy, work really hard at it, and try and roughly head in the right direction. And then you'll give yourself kind of the tools and the skills to make it successful.
What have you learned the most about yourself throughout the last, say, 10 years in your investment journey?
this is probably a bit deep, but I think I've realized that I optimize for happiness. That is the most important thing in my life. And when I was a lawyer, I was not happy. I didn't enjoy it. I was working 18-hour days. I was missing out with my friends and my family and everything else. And I realized that what's the point? I looked up to the partners, and some of them are good friends, but I didn't aspire to their lifestyle at all. So I thought, actually, I want to do stuff that I enjoy, stuff that makes me happy. And I think hopefully, material success follows. But the key thing is, if it doesn't, then I'm happy and I'm enjoying what I'm doing.
That's interesting. And what's your favorite restaurant in London?
Wow. Probably Jose, the Tapas Bar on Bermondsey Street.
Amazing. Thank you so much for being on our show.
Thank you so much for having me.
Wraps it up.